Hi guys, welcome back to Compounding Everything. For those of you that are new here, my name is Chris and this channel is dedicated to all things investing, finance and business. So before I get into this video, I think it's only fair that I'm honest with my intentions here. I know I have been away for a little while, and over the next few weeks or months, we will be getting back into the swing of things here, talking shop and stocks. However, I couldn't in good conscience go right back to business as usual without first making this video and staring straight down the barrel at some of the cold hard facts that we as an investing community are facing right now. However, before I do get into that, it would mean the world if you could just tap that like button down below the video. Like I said, I've been away for a little while, so it would help in encouraging the YouTube algorithm to remember who I am and hopefully get some of my videos back out there. Anyway, so what do I mean by cold hard facts? Well, across the board, we have seen some of the largest individual and index-based gains since the tech boom in '99. And I know, we hear that comparison all the time. So is this just another tech bubble that's about to burst, or is this time actually different? And although we can agree that nobody has a certain answer to that question, we can use a couple of indicators to show if the market has perhaps become irrationally overexcited, I guess. So in this video, we're going to be covering 5 potential reasons that a stock market crash might be coming soon, and how I try and manage my portfolio to handle a risk of an event like that. Now, according to many, an inverted Treasury yield curve is one of the most reliable indicators of an impending recession. In a normal course of events, longer-term interest rates are higher than shorter-term rates. Now, an inverted yield curve takes place when the situation reverses. Investors are willing to normally accept lower returns on longer-term debt securities than on shorter ones. One reason for an inverted yield curve is the expectation by investors that future investment returns will be lower than they are now. So investors flock to safe intermediate-term US Treasury securities to lock in current yields as protection against lower yields in other asset classes. Generally speaking, those asset classes would be stocks. Now, you might be thinking, well, come on, man, it's 2021. Yield curve, schmild curve. However, it is important to remember that the issue with ignoring the inverted yield curve is that one has preceded each of the last 7 recessions going back to 1956. However, the yield curve is only one possible indicator of a recession. So what are some of the others? Well, one would be the stock market cap to GDP ratio, which has become known as the Buffett indicator in recent years. Warren Buffett himself actually said that he believes it's probably the single best measure of where valuations stand at any given moment. The reason he states this is that it's a simple way of looking at the value of all stocks on an aggregate level and comparing that value to the country's total output, which is its gross domestic product. This relates very closely to the price to sales ratio, which is a high-level form of valuation. So where does the Buffett indicator stand right now? Well, at face value, it definitely doesn't look pretty. As you can see here, it is well above previous all-time highs, including the tech bubble and the GFC. However, everything is not always as it seems when it comes to the Buffett indicator. So what are some of the shortcomings in using this as an indicator for the next crash? Well, firstly, it doesn't take into account the profitability of a business. It only takes into account their top-line revenue figure, which can definitely be misleading. Additionally, the ratio has been trending higher over the last 30 years, and many investors question what a reasonable average ratio should be. Now, while the average has previously been around 75%, many believe that anything over 100% indicates the market is overvalued potentially. However, some are arguing that the new average should be closer to 100%, which I do tend to agree with. However, I think we can all recognize that an indicator of over 200% should probably raise some eyebrows when aligned with several other common indicators of a potentially overvalued or overinflated market. So how else can we judge the current market? Well, I mean, there are hundreds of ways, with some that are more accurate than others, but let's focus on just 3 more. So the first will be excessive valuations, the second will be widespread complacency, and the third will be irrational exuberance. Now, I know this is a touchy subject for some when we talk about PE ratios, because it has become a bit of a hated topic recently, or a hated way to measure a company's, I guess you could say, valuation. However, just for a second, let's take a look at some PE ratios of our economy and the US. So in Australia, over the last 40 years, we have averaged roughly 15 times earnings across the board. In some periods, we've gone as low as 8 times earnings around the GFC and as high as 23 times earnings in the dot-com bubble. Currently, however, we are sitting around 20 times earnings, and it is fluctuating a little bit around there, which has been slowly increasing since 2017. Now, honestly, the Aussie market probably isn't nearly as concerning as other international markets. However, as we know, what tends to happen in the US does trickle through to our market. So let's take a look at the PE ratios over the last 100 years on the S&P 500. The S&P 500 PE ratios have ranged anywhere between 5 and 123 over that period. However, the average has been 14.8. Now, when you look at this chart, they're currently sitting at a whopping 39 times earnings. Now, of course, that isn't as high as it was pre-GFC, but still high nevertheless. And I mean, you really can't help but think when you bundle a couple of these indicators together that maybe we're probably not on the winning side of history short term, at least when it comes to the S&P 500. So that leaves us with our old friends, widespread complacency and irrational exuberance. I mean, we could sit here all day debating these back and forth, but I think we'd be hard-pressed disagreeing on the fact that we definitely have seen both widespread complacency and irrational exuberance present more recently and more frequently than we may have in the last decade or so. So the inverted yield curve, the Buffett indicator, excessive valuations, widespread complacency, and irrational exuberance are definitely all present in one form or another, whether we like to admit it or not. But I mean, we could have said the same thing for the last year or two potentially. So doesn't that mean that this market could just keep going higher? I mean, yeah, it could. Nobody really knows what is going to come out of this market over the next 6, 12, or 18 months. Yes, we might look back and say, well, this was the most obvious signal. The writing was on the wall. But as always, it's easy to look back and say that because that's all we've ever been able to do in this situation in the past after these events have happened, unless of course you are Michael Burry. But ultimately, at the end of the day, these decisions have to be based around your personal risk tolerance. And that does bring me to the last part of this video, which is, does any of this really matter if you're managing your risk correctly? So what do I mean by that? Well, it has absolutely nothing to do with the securities or cryptocurrencies or commodities or anything else you might happen to be purchasing at this point in time. It really is about if you're in a position to handle the worst case scenario that might happen in the future. See, what's happening right now is people are becoming overexcited as a whole, and the enthusiasm of the general retail market is that you cannot lose. And what scares the hell out of me about that is when you think you can't lose, you're looking for even bigger gains. And from that, you can often start over leveraging yourself. So instead of you putting a standard amount of your portfolio into a certain holding, you might go, bugger it, I'm going to put 50% or 100% in because I know that this is going to turn into such a huge amount of money and that will change my life. And that is where this gets dangerous, and the sole reason I'm making this video is because I can't sit here and tell you when the market is going to top. If I knew that, I would be acting accordingly within my portfolio to make a lot of money. But I think it's important that we all recognize that risk is out there and you have to act accordingly. At the end of the day, if you're not putting yourself in a position that is detrimental to your overall financial well-being, it's your choice if you want to take a percentage of your portfolio and buy GameStop. However, unfortunately, from what I've seen in the last few months, most people don't seem to be managing their risks well. And trust me from experience when I say that taking a huge loss feels like absolute crap and knocks you out of the market for months or years. Not just because of liquidity issues, but because you mentally are fatigued and you just don't want anything to do with it. And that is the last thing that you want in your investing journey. It's just not worth it. So my question at the start of this video was, is this time different? And I'm going to give you a clear, simple answer. No. The one thing that we know for sure is that this time is not different. History always repeats itself. Humans get greedy and make the same mistakes. We see it in almost every aspect of our lives every day. Now, I can't tell you when this crash will happen because I have absolutely no idea. But it will happen eventually, and when it does, I just hope that you're in a position that you are happy with. Now, I did want to spend a second quickly before I end this video and address the future of this channel. I've had a handful of projects going on that I can't talk about just yet in regards to this channel. However, a couple of things that I did want to bring to this channel that might surprise a few of you and hopefully you will enjoy is talking a little bit more about the business side of things. I know that we've spoken about this in the past. However, recently, my wife and I have settled and sold one of our businesses, and it was a great process and there's been a lot of learning through that, and I think it would be great to share some of that experience on here. Now, a couple of other things that I'd also like to focus on would be cryptocurrency. Now, I know your ears are probably melting hearing me say that word cryptocurrency on this channel, but it's probably not what you're actually thinking. See, my experience comes from more of an old school cryptocurrency background with mining and running nodes on the blockchain. And I think that it would be interesting to talk about some of that on this channel and just give you guys a bit of an insight into how all of that actually works, because it's not some magical formula. It actually makes a lot of sense. So maybe that there is a couple of you that can learn something from that and enjoy that type of content. I really enjoyed that part of my life many years ago. In fact, seeing how it's all played out made me regret not continuing to do that and make it more of a permanent part of this channel, because it is a super interesting area, and I think that the blockchain is going to provide an incredible solution to many aspects of the commercial world in the future. So look, yes, the channel might have a few different aspects coming into the future, but all in all, it's going to be the same fundamentals and the same appearance coming here from my end. And look, I don't want to sit here and say that I'm going to be posting all the time every day. As you guys know, I've posted 2 videos in maybe 6 months, or maybe 1 video in 6 months. But it is definitely going to be more consistent. Now that I have sold one of my businesses, I have a bit more time on my hands, and it's something that I'd like to dedicate myself to a little bit more as this channel. And I mean, only the other day I really came back on here to look at the sort of financial side of YouTube in Australia. There's a couple of channels that I watched throughout the period I was away on and off. Of course, I'm always still looking at you know, the people that started around the same time I did, and you all know who you are if you're watching this video. Since that point, there have been so many channels that have come onto this platform in the financial space. Some of them are absolutely killing it, and congratulations to you if you are watching. However, from that means that there can be a bit of an oversupply of content in this space. And I'm always going to have my views and opinions, and I think I can add value in certain areas, but I do think that it's pointless me making the exact same videos as 5 other people if they've all got the same content. It really doesn't benefit any of you guys or add any value to you guys watching this channel. So I am going to try and diversify a little bit and add a little bit more value where I can to this channel. Of course, stocks are always going to be the fundamental base of the channel. It's my true love. It's what we all love doing here. But I think it will be interesting to add in a few more elements that I can bring in from my personal experiences. Anyway, guys, that is the end of this video. I'm hoping to post something again in the next couple of weeks. Keep an eye out for that. And of course, if you haven't already, please press the subscribe button and ding that notification bell. It will notify you when my new videos come out now that it's random and all over the place. Thank you for watching, and I'll see you in the next video. Cheers.